everyone. Welcome to this episode of my expert interview series. We are so fortunate today to have Ryan Goldsman with us. And Ryan is someone that I can pretty much guarantee you will not have come across in our real estate investor community. And there's a few reasons for that. So I'm going to start by telling you how I met Ryan, and then I'm going to tell you what makes him so unique. So Ryan, I've known for almost 20 years now, believe it or not. And I met him when he was a fresh-faced and cheeky young man who was moving to Toronto from Montreal. And he's actually my husband's cousin. So it's been a really amazing to kind of watch Ryan's journey as he started out as a bank employee and then transitioned into being an entrepreneur. Ryan always had hustle and game, was always working, and has managed in this day and age to build himself a really successful niche in the entrepreneur space. So I'm going to let Ryan tell you a little bit more about that. But thank you so much for joining us today, Ryan. Welcome.
Great. Well, that's a great introduction. Thank you for having me, Elizabeth.
It's our
So,
pleasure.
um, to kind of go through the bio, it has been a while we've known each other. I did, in fact, come to Toronto, took up a job with one of the big banks. Was there for about 7 years. I acquired all kinds of really, really good skills that I very much needed. I didn't have them at the time. And I learned what it was to deal with very large organizations, which across a lot of different industries, including real estate. Well, we deal with very large companies. And I had the experience of working inside of a few different large companies to figure out how it works from the inside out. Um, I did that for a little while. I worked for some insurance companies. I eventually went into teaching. And then in 2018, I started a wonderful company called Monkey Credits, where our tagline is get the monkey off your back, get your CE credits today. So we sell continuing education credits to the financial industry. So every year or every second year, if you are in the investment industry or the insurance industry, you have to get so many hours of continuing education to maintain your license or your designation. So we've been doing that since 2018. I write the courses myself and I sell them, and we have a whole broad suite of courses, including some on real estate. And then since 2022 or 2023, we've been offering through a separate company called PAIP Canada. It's PAIP, so it stands for Planning and Investment Practitioner. And in Ontario, they finally passed legislation to say if you want to call yourself a financial advisor or a financial planner, you must have one of these approved credentials. So basically, I went out and I launched my own designation. And I was doing already exam preparation for the CFP and stuff like that. So it was easy to kind of go in and restructure things and add on the things I felt should be there. We focused more on the investment side than the CFP, and we tried to take out some of the more boring stuff, of course.
Luck with that.
Don't tell them I said that. And we made the application to the government, so we're trying to get on the list to become an approved credential. And that's proving to be a very, very diligent process. So there was really, I think in the real estate industry, it's like being a home inspector. Like anybody can call themselves a home inspector, or at least they did back when I did real estate. So when I was at the bank, I did own a few different properties that I owned directly through a corporation. And it was a great experience, but it's something that I wanted to do other things after that. So I sold out of that. And here we are now. I'm in the education space, and it's fantastic. I'm really enjoying it.
Fantastic. Well, we're happy to have you. And I want to back up a little bit and kind of unpack that because you went very high level, which I appreciate. Let's start with CFP. So if someone is not familiar with a CFP designation, what is that and what does it mean?
So it's in financial planning. If you're a certified financial planner, you have the CFP designation. So it's everything to do with registered plans and government plans and taxation, insurance, and the law, all this fun stuff, right? And investments, of course. So I got that designation in 2010, and I've been selling the continuing education credits you need, I guess, since 2018. So effectively, sorry, if you walk into like a bank branch or deal with a financial planner or investment advisor, you want them to have some sort of a credential, and one of the best known credentials is the CFP designation.
Perfect. Okay. So in order to be able to sell investments, you need to have or provide financial planning advice. You need to have a designation, CFP being the most common one.
Yes.
Gotcha. Okay. I remember, Ryan, you started teaching for George Brown College. Tell us a little bit about that piece because that seemed to sort of start your journey into the education space.
Yes. So at George Brown, it's actually a funny story. Somebody I knew who was there, who was full time, said, "Look, we're launching this course. We have nobody to teach it. We're launching it in the summer, and according to the union agreement, I can only do half of it. I have to take half the summer off. Can you come in and teach for like 6 or 7 weeks?" And I went, "Well, I'm not doing anything else, so sure, why not?" And literally, that's how I got hired on. Like, that's how I started there. And I taught call center operations, which is back when I went and got a job at the big bank. Part of the training is they said, this is how you go about your day-to-day activities in a call center. They gave you the training. Apparently, they no longer did that, 10 years later. And so now they had a college course literally that taught you how to work in a call center. So that's how I got hired. And then they said, well, can you do this next semester? I went, yeah, sure, why not? Because I thought to myself, I don't really want to go back and work for one of these very large banks or insurance companies. This whole teaching thing is going okay. That was, I think, in 2016. And then within a year or two, I figured out that I wanted to do something online direct to other professionals. So that's not a very good story about how did you get into teaching. Like most people who I got to know who were teaching, they kind of fell into it.
Yeah.
Very few of them wanted to like go on and become these great professors. So
Yeah.
yeah.
And it's so interesting that you mentioned that because it parallels, the same journey that my husband Emmett and I went on too, where, we took courses at Rich Dad. We loved our courses. We went out, we started applying the information, and we were doing so well that the company said, "Hey, would you be willing to come back and talk to our students? Like just, show up at a creative financing course and, spend an hour or two, answer questions, talk about your journey." We're like, "Hey, no problem." And I did that, and by accident, I realized how much I loved educating and teaching. So then I became a trainer for Rich Dad for 8 years, and then I became a coach because I feel like it's almost like a calling. And the way that people get into it isn't always the traditional way where, I go to university, I get a degree, and then I want to be a teacher. A lot of times, especially for adult education, we fall into it a different way. So I love that part of it.
Cool. Yeah.
And the second piece here is really the entrepreneur piece. And I love that you saw a gap or saw an opportunity and you realized that you had the skill set and the vision to be able to close that gap. Which, again, for a lot of entrepreneurs, that's how we get started on this journey. I don't know that there are very many people who, in their late teens or in their early 20s, they go, I want to be an entrepreneur. I want to be self employed. I want to start a business. I think a lot of us just see an opportunity. And I remember talking to you, and you weren't super happy working for a lot of the big banks. You had some challenges with some of the things that you were being asked to do or asked to say. Somebody else was telling you what you should and shouldn't do. And I mean, yes, granted, you are a fresh faced and cheeky 20-something-year-old, but at the same time, you had some ethical objections to what you were being asked to do.
Oh yeah, and I mean, I've spoken to enough people, a sufficient number of people in the industry, and I've asked them like, how do you like working here? Like, why not go to another bank or whatever? The people flat out will say, well, they're all the same. Literally, that's what they say. Well, they're all the same, and in certain ways they pretty much are. Like your day to day as a teller, as a financial advisor, as a branch manager, you're at one bank versus another. It's all pretty much the same. And I was on a Reddit forum or whatever, and somebody was asking in Personal Finance Canada on Reddit, which bank should I go with? This is what I do with my bank. Like they don't go in, they use the app. And the answers were basically, what's your favorite color? Go with them. And I thought, no, 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 no. There's got to be more to it than that. And apparently for certain people, there's no more to it than that. So in my case, what happened is several years, I'd never written a book. And then years and years ago, I was reading a lot. I read a book. I went, this is awful. I could write a better book. Um, I won't say which one of my competitors. I was on their website and I went, I could probably do this a lot better. And I got kind of upset with them. And so I went ahead and I did it. Um, and that competitor's still open. I don't know how many clients they have left, but they're still around. So in my case, that's what happened. It was an industry that nobody was doing anything exciting. Nothing revolutionary had happened in basically forever. And it was like kind of like the internet 1.0 versus 2.0 because we deliver courses online. So people got comfortable with their how to set up a company, a website to deliver courses online. And everyone kind of stopped innovating because it's not the biggest market. And I just arrived, I looked around at a time and I went, like, this is like Shopify was just emerging. And I went, okay, we can do this a lot easier. I got hooked up with the right tech guy who is way smarter than me and really great at what he does. And he went, this is what we're going to do. And I was very impressed by it. So it's gone really well so far. I've been very lucky.
That's amazing. And your timing is impeccable too. The fact that, you kind of launched 2018, 2019, and then boom, the pandemic happens, and all of a sudden everybody else is struggling to move online, and you're already there.
Yes. So I don't want to, I'm knocking on wood over here. I don't want to be the guy who goes, oh, yeah, I benefited quite a bit from COVID. Um, but yeah, when in person got canceled, I did have to deliver a lot online, and it's exclusively online. So instead of delivering so many courses, it became that much more because nobody was doing it online. So there were benefits, but even since COVID, every single year we've sold more courses than the previous year.
Good for you. So you're in growth mode. That's fantastic. Congratulations.
Thank you.
All right, so let's move into talking a little bit more about investments specifically now that we kind of know who you are and why I thought it was so important that you join us today. So there's a lot of stuff out there going on in the world of real estate investing right now. There's a lot of capital raising. There's a lot of private lending, money moving around, registered funds, non-registered funds. There's a lot of competition. Like I remember a few years ago, I went to see my mom's financial planner. She was completely threatened that I was a real estate investor and that I thought my mom might want to put some of her money into a private mortgage. There's a lot of kind of there's a lot of gaps, if that makes sense. So I would like to have you because you and I started having a really interesting conversation a few weeks ago when I was just out walking the dog. And I'm like, wait, 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 wait. We need to get you here and talking about this stuff because nobody else is in this space. So can we make a list of like the gaps that you see for real estate investors? What do we not know about investing, about due diligence, about choosing partners? Like what's
Mhm.
not being talked about?
Well, first of all, you're more polite than I am in saying there's gaps. It's saying like we're all together like a piece of cheese and that Swiss cheese has a hole in it. I look at those who do real estate investing, those that do traditional financial planning. I always thought about it like they're two separate camps and they're not trying to connect with one another at all. Like you can take a real estate investment and add it into a financial plan. You can have real estate investing as or an individual real estate investment as part of your whole portfolio. You just have to kind of factor it in, program it in the financial planning software, right? And at the same time, a financial planner can help you with, let's say, cash flow analysis or something like that, or if they know something about a corporate structure versus owning something individually. So one of the biggest issues is, at least in the financial industry, which I'm probably more familiar with than the real estate industry, is that you have a whole bunch of people who are employed by very large firms that haven't really said, okay, like this is how we account for some of these investments, and this is what we can do to diversify a portfolio to support what they're doing over there, instead of just like, oh no, 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 we're not touching this. And literally some of them are like, oh, well, we can't help you there. And I've seen that happen. And it's like if somebody's portfolio is $1 million, they might put 500,000 in real estate, 500,000 in, passive investments, and the whole thing will walk out the door because whoever's behind the desk doesn't want to do anything for the half of it, because the other half is somewhere that they can't see it. And the second thing that I think is an issue is when you buy a stock or a bond or a mutual fund or an ETF, whatever it is, you put the money in and that's kind of the end of it. It's not like they're going to call you up and say, well, the roof fell in, so we need you to come up with another $10,000. And
Hmm.
so when you look at real estate investing, if you own it directly, where you're on title, it's your own property, that can become a bit of a liquidity challenge. So having access to credit on short notice is definitely a good thing. It's like anything else. It's how you manage your day-to-day finances. It's going to change if you're doing one versus the other, and just trying to put the two of them together, which is a good thing.
Hmm.
Um, that's just a challenge for some of the professionals in the industry, I've found at least.
Yeah. And I remember you and I touched base a couple of years ago because I had a client who has a high net worth, who owned almost 2 dozen properties, and we were trying to do some financial planning, and we could not come up with a solution for how to do the future modeling and planning. And there was no consensus on opinions across the board about when she should start to liquidate and when, it would make sense. If you have 2 dozen properties, then do you put some into a trust? Like, what should you do? And there was no consensus. I mean, there's certain principles that you want to have, such as diversification, but then, like you said, there's no one professional you can go to who says, okay, let's build you a diversified portfolio. Here's the ideal. You should have X% in real estate, you should have X% in stocks and bonds, and those different things. So it kind of becomes whoever you talk to, that becomes the prevailing opinion, and there is no real lighthouse in this space for what is the ideal thing that you need to do. And what's ideal for one person is not going to be what's ideal for another person either.
That's true, and personal preference will play a role for sure. Um,
Yeah.
I don't know what happened with that person in the end because I couldn't find somebody. I'm embarrassed to say it. I couldn't find somebody to help him or her. So
Well, and the interesting thing is your dad is extremely well connected in this industry too. Like, he was a professor at McGill University teaching
yeah,
taxes, right?
yes,
And we still couldn't find anyone. So it's not that we didn't give it, we didn't put time and energy behind it. We just literally couldn't find the right person who could come in and kind of speak to that, to what this looks like. And as you said, a lot of times for financial planners, their pay comes from investing your money. So they have
yeah.
actually the opposite of a desire to help you take your money out and put it into real estate, into mortgages or investment properties. Unfortunately, their primary motivation, because it's their bread and butter, is on to help you invest in items that they sell already.
Yeah, so that is true. That's starting to change. So at least with mutual funds, we've done away with commissions. So this idea of being tied in for 6 years on a declining sales charge, or what's called a DSC, that's gone. That's largely gone away. A few more years, it'll have gone completely away. Um, but there's more. There's an emergence. There's more and more fee-based financial planners out there that'll say, "Look, we'll sit down. We'll do it all for, let's say, $5,000. We'll do everything. Then we'll charge you so much every year after that."
Mhm.
Um, which is a really good thing. But then the problem becomes if you're going to go see a fee-based financial planner, your situation had better be more complicated than simply, hey, CPP, EI, company pension, RSPs, TFSAs,
Mhm.
and you're an employee somewhere. Like that's not worth spending the money for. And you need to have like I don't want to say a substantial net worth, but enough to justify spending $5,000 or $10,000 to go speak to that person because they're paid directly from you. And
Yeah.
so there is a lot more of that happening. So I expect the support for real estate investors, at least from a financial planning perspective, to be a lot better in the next 10 years versus, let's say, the last 10 years, where I know like to do a self-directed mortgage, you could have gone with the big banks and now they've said, no, no, we're not doing that anymore.
Yeah.
Like the anti-PCML TFSA or something, the anti-money want, I don't even know what I saw it yesterday. That's how I remember. Um, anti-money laundering. terrorism financing, something or other. All of that stuff has gotten so tight for the Canadian banks, big financial institutions. They're subject to so many audits. They almost just don't want to go into certain businesses where it's more challenging to actually oversee it, to monitor it. So they're just like, yeah, we'll just get out of this business.
Yeah.
Which,
Which, in fairness, I mean, you look at the Epic Alliance debacle that happened a few years ago, and I don't know if you're familiar with that or not, but there's a company out of Saskatoon that had a few different ways to invest with them, but it sort of came to light after the company fell apart that some of the building appraisals were being manipulated, that they were basically controlling the market, so they were pushing valuations up artificially, and there's a whole bunch of different things. So in the self-directed space, a company like Olympia got burned pretty badly in that, and as a result, they have changed their rules around, what you as a borrower need to do and what the lenders need to, or sorry, yes, what the lenders and the borrowers need to do. So I think this is another example of a lot of the space that we play in as real estate investors is largely unregulated and uncontrolled, which subjects us to a lot of risk. And one of the things we've seen quite a bit recently, there's some companies out there who people have invested in their funds, in their REITs or in their development funds, and they've gone under and the funds have basically evaporated. So, one of the things I really wanted us to touch on was due diligence in terms of how do you, with your knowledge as a financial planner and from kind of that other perspective, how do you conduct due diligence before you decide to give a company your money?
well, that's a very good question. We're actually we're actually somewhat, I don't want to say in a bubble, but we kind of live in a bubble in Canada because we have an oligopoly. It's five or six really big banks that they have so many people in compliance. They're subject to so many regulations. We don't really have to think about it. We can be like little children and go, everything's going to be fine. Go to the bank, give them your money. And that's perfectly fine. You're never gonna get a market return. You'll get a return that's a little bit under what the market is, and that assumes a highly liquid market. And so you're never going to do extremely, extremely, extremely well. You're always going to be fine. You won't have to worry. So we're kind of spoiled from that perspective. The real challenge comes when you're going with a smaller company. It could be a startup. It could be a less liquid type of approach. So it's not just real estate. If you look at, let's say, online sports gambling, which is now legal in Ontario, there are certain funds that are starting that are trying to do that. And they're trying to run it like as a fund. The way you have a mutual fund, you buy 50 stocks, they're trying to run that as a fund. You can make investments in fine wine that is aged for you now. So that's interesting. You can also, in the US, you can buy a share or a partial share in the high-end art market. So if you can't afford a full Picasso, you can get a portion of a Picasso.
I own a 1 inch of a Picasso painting.
Yeah. So and for those who are at home thinking that kind of could be kind of cool, like a conversation piece. I spent $700. I bought a 1973 bottle of wine, which is the year Pablo Picasso passed away. And so they put a Pablo Picasso print on the bottle of wine that year. And so I kept that empty bottle. I have it here. The wine was fantastic. The empty bottle is probably about $300 or $400, but it's not going anywhere. It's staying right here.
So some people shouldn't find you afterwards and make an offer for you.
Oh no, it's no, no, no. That's no fun. The fun is having it and showing it to people. And also with rare bottles of wine, the empty bottles, they're actually worth so much because people get them, fill them with wine, and counterfeit those bottles. So if I have a really old bottle that I'm going to throw it, I actually break it before I throw it out. If I don't keep it. Anyways, so oh yeah, I'm telling you, if people can rip you off, they will. So um, I won't tell the
So
other. I won't get into wine. We could spend 4 hours talking about wine and some of the things that happen there. So for some of the due diligence, one of the things that I look at, it's not just about the character and who are we dealing with, what's their track record, but if somebody is as simple as like stating returns, they say we did this project, our returns were 142%. Okay, so that's good. That's a good piece of information. Now, over what period of time? Is it over 9 months, where that means annualized it's more? If it's over 2 years, well, it's not this much divide by two. You actually have to look at something called GIPS, which is Global Investment Performance Standards. So anybody who's like a portfolio manager who's buying and selling securities, so stocks and bonds and all that, they're probably going to be a CFA charter holder. And the CFA Institute, which is globally recognized, put out this thing called GIPS. So these global investment performance standards to say, if we're going to report returns, well, you either are GIPS compliant and you follow those standards to report them, or you're basically not. And so now, if let's say you have, a pension with $100 billion, they might want to get on a plane and fly to somewhere in the world that's not Canada or the US, and they're going to sit there and listen to the presentation. They might want to give them $1 billion. They're going to say, well, look, all these returns, what's your methodology behind the calculations? Is it compliant with GIPS, which are Global Investment Performance Standards? So no matter where you are in the world, you say, I report my returns according to this. So it's a proper annualized return since inception. And as an example, if you get a 10% return this year, and then you get a 10% return this year, or the year after, sorry, so 2 years in a row, 10 plus 10 is 20, divide by 2 is 10. Well, that's the arithmetic mean. If we take the geometric mean, it's 1.1 times 1.1. And then you take the square root of it. And so you can actually, oh no, I know, you think the average is the average. Then there's another one called the harmonic mean, which isn't even relevant in this case. But there's all kinds of ways to calculate the average. So they say, look, if you're doing it over multiple periods of time, you have to link it together where if you, let's say you have cash flows in and out of a fund once a month, you have to take the square root to the 12th power, 1 over 12, because you're geometrically linking these 12 months or the 12 separate returns, one for each month. So what ends up happening is that when you have rates of return that are stated in any presentation, I don't think I've ever seen one that I would say, I'm holding this up saying I believe in this. Because through my background in the investment industry, I know that these are not properly stated. At the same time, how you account for cash flows of a real estate investment versus the capital appreciation, which you realize once at the end when you get the positive cash flow coming in, well, those are two very different things. One is cash flow, one is once at the end, the capital appreciation. And then when you back out the taxation of all this sort of stuff, and what your personal situation is, if you put it in a company and then you pay it out to yourself, you might get half of it as a dividend that's tax-free at the end, but the income you may have to pay for, and then you have capital cost allowance. Basically, I have all this gray hair. You may not be able to see it, but this is kind of why. I did real estate for like 5 years. I know we talked about it when I was doing it. It never went well for me, and I got out of it. It was like kind of like buying a boat where the best days are the day you get into it, the day you get out of it. My career in banking was the same thing. At least for me, I found what worked for me. And if people are sitting there going, this XYZ doesn't work for me, well, maybe it's time to shift and do something different, because the real estate market is absolutely huge, just like the financial markets are huge. I got into the education of it. One of the things that I've thought about is getting into the education of real estate. So that's a different story. Back to your question, though. The other ways to do due diligence, it's not just saying, hey, are you GIPS compliant? If they sit there and they go, GIPS doesn't matter, I don't think I'm going to give them my money. It's okay to say, I have no idea what that is. I've never heard about it, because it's not really for real estate. It's for investment management. You just have to ask them, like, how are you presenting your returns? Who's holding your money? If it's a real estate investment trust, a big one, they might have like a transfer agent or something. If it's publicly traded, there are just certain questions you want to be asking, and you want to know who's involved. Like, who's the CFO who we're probably not going to speak to, because if they've been indicted for fraud like 3 times, I know you're laughing, this happens. Well, you probably don't want to deal with that person. And
Yeah.
literally, you'd think if somebody's embezzled for fraud once, they go away. No, no, they figured out all the little loopholes and the intricacies. They're just going to keep coming back.
Yeah.
It's really ridiculous. So you really need to be looking at, who am I giving my money to? Who's making the investment decision and who's ultimately accountable? And does that person have character and integrity? If the answer is
Yeah.
no, then just go find somebody else, because there's no shortage of people who are asking for money, trying to raise money. Especially now that there's higher rates, everybody's kind of, um, I guess they're kind of sinking. The tide's going up and it's around their neck. Um, I mean, Warren Buffett says when the tide goes down, you know who's been swimming naked,
He
but at
does.
the same time, you're also drowning. So um, there you go.
You took me back to a very unpleasant place, Ryan, and that was my stats class in university. And one of my biggest takeaways from my stats class in university was you can manipulate numbers in a way to make them say pretty much anything. And I think that's really what I took away from your comment about GIPS is that if you don't know and understand the methodology behind how people or organizations are coming up with their numbers that they're presenting to you, then you really need to dive into that and determine. And there will be some big companies that won't want to share that information with you. And to me, that's a red flag. And then there will be some smaller companies and smaller investors who are like, hey, here, look at my spreadsheet. Let me show you how I came up with these numbers. Let me show you the default assumptions behind the numbers that I'm presenting to you. And I have a greater level of comfort with that than I do a lot of times with some of the bigger companies who just they don't need to show you. So they don't.
That's true. And one of the big differences between direct and indirect investing. So if you buy shares in a REIT, they have audited financial statements. They have to be filed with regulators, like on the Toronto Stock Exchange every quarter. If it's private, if you own the company, well, you are on title. That's a direct investment. So um, it's kind of like between the two. When it's a large organization that's not publicly traded, well, then what do you do? And so then you have to go and ask questions. And that happened once when I was at one of the big banks. We were doing due diligence on a hedge fund, not me personally. And our team came in and said, yes, I know you all want this on the platform. They won't provide this information. So they're saying it's proprietary.
Hmm.
And so we can't get them on the platform. We can't do the due diligence. And look, maybe it was proprietary. We don't know. Maybe at the same time, all these results were completely made up. We don't know. They never got on the platform um, because they couldn't show their past transaction history. We couldn't do the due diligence. So
Hmm.
I get it when it's a bunch of securities, but if it's a bunch of individual properties that you're buying, I mean, if you bought them in the past, I personally don't see how that's too proprietary when it comes to real estate, because each investment, it's not like buying a share where it's interchangeable with the other million shares outstanding. Every property is at least a little bit unique. Some of them are very
Hmm.
unique if you go outside the city and buy a piece of land or whatever it is.
Hmm.
So yeah.
One of the big challenges I think right now for investors too is that there's a lot of people who started MFTs and some of these other fund types in the last year, in the last 2 years, because there's been changes around syndications and how many people are allowed to be part of a deal when you're raising capital. So people have started funds with the idea behind, I'm going to fund my portfolio with this, from this fund. And one of the biggest challenges is getting honest and accurate information about the track record of these investors that people are thinking about putting, hundreds of thousands of dollars in, registered and non-registered funds, thinking of placing it with.
Yes. So first of all, when you said NFTs, do you mean like a non-fungible token?
MFT, mutual fund trusts.
Oh, okay. Sorry about that. Because I was going to take a real swipe at NFTs and how they're complete garbage. But for anybody who's into NFTs, I'll quickly say it. They came about when crypto was very, very hot, when we were in lockdown. without crypto, we wouldn't have had NFTs, and we were in lockdown, so people had to collect something, and now they've largely went away. Anyways, going back to your question about, what happens like when the rules change and stuff like that. When you look back to, let's say, Bernie Madoff, which is like literally, they shouldn't call it a Ponzi scheme. They should call it the Madoff scheme because it's the biggest in history, even adjusted for inflation over the last several hundred years. He had all these different feeder funds that were around his fund feeding into his fund. So it's great that we say, where is this money going? Who's it with? Who's guaranteeing it? I mean, I can guarantee your $1 billion. I don't have $1 billion. I mean, that's a print that you have on the wall right there above my shoulder. It's not an original. So who are you giving your money to? Who's ultimately responsible? And do they have it? Because if the wrong person is guaranteeing it, what ends up happening is that they go and they declare personal bankruptcy. Now, if you have student debt, you have to wait, I think, 7 or 10 years after graduation to declare personal bankruptcy. If you do it before that, it won't get wiped out. If you owe money for child support or spousal support, it doesn't get wiped out. There are certain things you cannot discharge in personal bankruptcy. Only saying, I guaranteed an investment, it went bad, that's going to get wiped out. So that person's life may not be great for a while, but you know what? They don't have assets. You don't sue somebody with no assets. You sue the bank. That's why banks are always so careful, because they have all the assets. So
Yes.
ultimately, you have to ask, who am I giving my money to? What guarantees do I have, if any? And if they don't have to. This is real estate. They don't have to give you a guarantee of anything. It's great that they're going to put a lien on the property and all the rest of it. That's fine, as long as the property value stays the same instead of going down, which it's an inverse relationship to interest rates. I'll explain in a minute if needed. But then the thing is, where are they sending the money to? You have to ask them, where's this money going? Like, what are you doing with it? Like, if I write it to this company and I hold it off the check, is this the company that's on title? Like, what are we buying here? Like, you have to
Yeah.
ask questions, and if it's a nuisance or they're getting upset, they're probably not people you want to be dealing with. At the same time, if you're calling them at 9 o'clock on a Friday night and you start asking questions, they're probably not going to be happy. So do it on a Tuesday morning.
Yeah, exactly. You brought up a really interesting point, Ryan, where there should be some level of responsibility from the borrower as well. The borrower, I mean, when I'm doing my private lending, I'm looking for a borrower who is going to take even more care with my money than they do with their own. And I'm looking for them to have the means to be able to make good. If there's a shortfall, that there is equity or there are funds available somewhere else because they care more about their reputation in the industry than they care about, one particular deal. That's one of my due diligence metrics I look for. It's hard to find though.
It is hard to find. And by the way, Jeff Bezos, figuratively speaking, blew up a few different hedge funds before starting Amazon. So, so the question is, when we look at risk reward, I can understand Jeff Bezos blowing up a bunch of hedge funds before starting Amazon. It was a high risk, high reward. It was an equity investment that people who were giving him money weren't bond holders, they were equity holders. If you're loaning somebody money, you're in line ahead of them in terms of if there's a bankruptcy. At the same time, there's collateral, so you're going to get a lower rate of interest. If there's no collateral, you should get a higher rate of interest. It's a bond versus a debenture. A debenture has no collateral. Then above that, if you're going to go and become an equity investor, you're going to own a part of something. If you're going to go fund like an artificial intelligence company, the thing could go to zero. You could get nothing. But if you're going to go fund a real estate company where the company itself is on title and buys these properties, well, the property, even if it doesn't work out, should be worth something. If there's some competent management somewhere, the building is still standing, rents are still being collected, and people are still getting paid. It's when none of that happens, I don't really have an answer. I mean, call the police and have them investigate. It's potentially fraud. I don't know. So the question is, how much risk am I taking? If I'm loaning money, I'm a secured lender. who else is in line ahead of me? Most probably whatever bank is funding 80% of it or 60% of it, whatever the loan to value is, they're probably first in line. And so as interest rates rise, the value of properties typically decline because, well, let's face it, if there's zero interest rate and you can afford $10,000 a month, you just pay $10,000 a month. But if those interest rates are going up and up and up, now there's an interest component. So your principal repayment component goes down. So you can effectively buy a property for a lesser amount because your monthly payments stay the same. So it's really not that hard. When we hear about interest rates going up, it's a headwind for the real estate market. And so people always say interest rates went up. That's fantastic. They look at their investment portfolio. Well, all my bonds went down in value. It's because you locked in at a different rate. Interest rates went up. What you had still pays the same rate, so the value went down because I can buy the same thing for a higher interest rate. So right now in Canada, I hate to say this because probably a lot of the people listening, they probably own real estate or they want to be long. I don't think most people are tuning in because they want to short Canadian real estate. If we didn't have somebody who I'm not a fan of, who is leading our country, increasing the total number of new immigrants that we're welcoming into the country, we would be in a total recession because they point to the economic numbers and say, GDP has gone up. That's very true. GDP has gone up, but so too has our population. GDP per capita, so per thousand, per 10,000 people, has declined. And by the way, in the United States, if you have 2 consecutive quarters of negative growth in the GDP, so it contracts for 2 consecutive quarters, by definition, it's a recession. In Canada, we used to have that as well, but then somebody in government, I think the Bank of Canada, went ahead and changed it and said it's a severe and prolonged period of economic contraction, which is a really vague way to say we can call it a recession when we want, or just never call it a recession. So
We'll just name it something else.
Yeah, we'll just make the definition really vague. So what ends up happening now is that if we understand that a recession is my quality of life, and I'm an average person, the average quality of life of my neighbors and my friends is just not as good as what it was a year ago, well, we're in a recession. Well, we're pretty much in a recession right now, but nobody wants to say it out loud. So, yeah, sorry about that.
No, that's okay. I feel like we could talk and talk and talk, and you are such a wealth of information. And because you're not from the traditional real estate space, you have such interesting and unique ideas. So I know we need to wrap up for our interview today, but I'd love to have you back again. And I'd like to take some time once people watch this interview and get a sense of what other questions people have.
Yeah, absolutely. And I understand, I mean, every show, podcast, whatever it is, has its market, has its audience. If your audience comes back and says, get this guy out of here, well, I mean, I'll have to move on to the next show. And if people have questions, please ask them. It's going on YouTube, right?
Yes, it goes up on YouTube. I also email it to everyone in my in my email list.
Okay, if you put the questions, I don't know if I can answer them or I have to send you the answers. Put the questions in the comments. I'll get answers to you for sure.
That's wonderful. Well, thank you so much, Ryan, for sharing your time and your insight. I appreciate your tips and suggestions on how we can do a better job looking at where we're placing our funds, and trying our best. I mean, ultimately, I like to maintain control of my money as much as possible. So I like the idea of doing more due diligence before we put it with anyone.
Great. Thanks for having me, Elizabeth.
Thanks, Ryan. Have a great day.